All right, everything looking good. We are live. Let's go ahead and get the stream started. Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market look ahead. It is 8 p.m. Eastern Standard Time on Sunday, May 8th, 2022. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. Hey, what's going on, Yoda? Good to see you. What's up, everyone in the chat? Somebody just let me know everything is coming through loud and clear. But that being said, let's go ahead and jump right in. So let's just start with our general rundown. So here we have the TNX closed out this past week at 3.122, a new cycle high, obviously a key level to pay attention to. And, again, just continuing to aggressively move to the upside. So at this point in time, the main thing that we're paying attention to is still that previous level. So we're essentially at or approaching that level. I'm not sure how clear it's going to show up on here, but you guys can see right here, this is that 3.122 level, and this is basically the price action that we had above it back in 2018. So I've switched over to the weekly chart right now. So essentially what it amounts to is this week broke above it, and then we were above it for 1, 2, we closed below it, closed back above it. So basically about like 5 or 6 weeks right here. So we essentially had what amounts to less than 2 months at or above this level right here. So we're very, very close to that level, and the top of that level being essentially, depending on if we're going by closes or wicks, it's basically 3.233, and we're at 3.122. So we are essentially at this point in time, 0.11 away. So, I mean, we are extremely, extremely close. We're essentially, one weekly candle from taking out that level. And obviously that level is extremely important because if you've been watching the channel for any amount of time, we've been in this downtrend for 40 years. So if we've been in this downtrend for 40 years and all of a sudden we take out the previous high from the last move up, that means we're basically breaking out of this downtrend. And as if that wasn't already clear, we basically went into this bear market essentially back in 1986, and we're now back on top of the 200 exponential and simple on the weekly basis for the first time ever, since this chart going back over 40 years. So in 40 years time, we've never even been above the 200 exponential or simple. We've never had the 200 exponential angle to the upside. And at this point in time, I mean, the 200 simple is essentially flat. So it's probably sometime this week, depending on price action. If not next week, we'll be actually going to the upside. So I'm sorry, we switch over to the monthly. So that's on the monthly. Sometime this month or at the end of this month, if we close above the 200 exponential or simple, we're going to probably flip that 200 simple blue again. So that's the first time, we were obviously in a powerful trend throughout the 60s into the 70s, 80s, and then here we saw the peak, in 1981. Obviously, everything going on back there, crazy runaway inflation, etc. And then from that point in time, we went back into, this deflationary environment, this downtrend on rates, and then we trended what amounts to all the way down to zero. Because we hit 0.4. So at this point in time, we are literally a candle a week, away from a technical breakout. And then on the monthly time frame, again, we see those same two key levels to watch right here. We have the close was at 3.159, and then the next week's open obviously at that same level. So 3.159, and we're at 3.122. So at this point in time, we're like 0.037 away from a technical breakout. So, I mean, we're essentially there. I mean, if you're bearish on rates or bullish on bonds, you're expecting this to double top right here, or you're praying it'll double top right here, or else you're basically reaching invalidation levels. So this is extremely, extremely important. Obviously, we have been talking about this for literally the past couple of years, discussing this parabolic trend and the strength that was coming from this. And now here we are at levels that people never thought that we would reach. And we're essentially breaking out of that 40-year pattern. And again, if we just turn on our drawing tools for a minute, and then we switch over from log We can see the green channel right here, basically creeping down. Obviously, there's a lot going on in this chart, but we've been inside this green channel since the peak back here in 87 and since the low back here in 86. And again, if we zoom in here, we see when we came in 2018, we poked out for basically 2 months and then broke back down, but never got above the 200 exponential and simple. Here we have a clear break. We have a massive bullish close right here. And now we have two big green candles since then. Not only have we had a technical breakout, not only have we hit the measure move of the inverted head and shoulders that we had planned out literally, months ago. Now we have taken out the 200 exponential and simple. The slope is angled to the upside on the 200 exponential, and we're still continuing to just run to the upside. So we're very close to taking out that key level, at which point in time, we then start looking at other key levels like the technical breakout of the actual channel itself. And we do that by taking the measure move from the bottom of the channel to the top of the channel and then extrapolating that from the breakout point. And depending on how we look at this, we have essentially two potential targets to the upside, and it just so happens to line up with the 1.618. So, are we going to get up to 5% rates? I know it sounds crazy right now, but it's not that unrealistic. And then when we start looking at the macro fib and we take it back from that 40-year high all the way down to our 40-year low, we realize that, we're basically not quite to the 236 yet. So the 236 is actually up here at basically 4%. So it's not that hard to believe that we push up here to 4%, come back down, cool off for a bit, and then potentially even go higher. That would give us our 1.618 fib target from that previous high in 2018 to the low in 2020. The 1.618 gives us 5%, or alternatively, something like the 382 is at 6.3%. So at this point in time, we have broken out technically. Now, is it still possible that the breakout fails, and rolls over? Yes. But at this point in time, the main thing we're watching is that previous peak in 2018. This is still very powerful. We obviously have, if I turn off the drawing tools for one more minute, like we said, the 8 and 21 across the upside on the monthly. We're above the 200 exponential. It has positive slope. We're above the 200 simple. Doesn't quite have a positive slope yet. We see on the TJD, TDMACD, all green histograms, blue slope line above the zero line, bullish control zone. Both Stochs are still angled to the upside. This is the only thing that could be more bullish on this chart right now, is basically the 200 simple flipping to the upside. And if nothing happens, it will happen on its own. So this is a very bullish setup. This right here is essentially what value investors look for. When a trend goes to the downside, you leave it alone, let it go down for as long as it wants, and then when the trend starts to flip back to the upside, that's when you really start to get interested. And that's the point we're at right now. Things are getting very, very interesting. And, if this is correct, and we do have a technical breakout taking place right now, and we see this, going up to 4 or 5+%, we're talking about an absolute destruction of TLT. So just taking a look at the TLT chart right now, the 20-year treasury, this is the actual bonds, not the rates. We see this thing is continuing to just absolutely melt down. No surprise, of course. We've been expecting that. But we are now taking out key levels. We have basically broken down from the descending channel that we've been in since our peak in the Rona, pump. And then now we're actually breaking through the downside of the channel that we've been in, this giant ascending channel. And again, I'm going to switch over to the monthly for a moment. So we have this giant ascending channel that's been basically going back to our low in 2007. And then we also have like this kind of arching support that I've added in here as well. And we have broken down from the arching support, got a massive sell candle. And now here we are at that key level, that support of the channel. Now the bottom touch right here isn't the best. We have like 3 pretty clear touches here, but on the top we have some very clear touches as well. And then we had basically a failed breakout that rolled back over. And now here we're testing the bottom of the range. So we tried to break out to the upside. We did break out, but the breakout failed. It was rejected. It was essentially a throw over. And then we saw distribution taking place. We hit the LPSY, last point of supply, and the head and shoulders. And now we're breaking down, hitting the measure move of the head and shoulders. So at this point in time, we're down below. We're seeing that same situation play out. We're down below 200 exponential. It has already flipped over red. We're down below 200 simple, but it's basically flat at this point in time. So we're at a decision point. So even if you don't believe that bonds are going to break down any further, even if you don't believe yields are going to go up any higher, we're at a key level that one way or another, whether you're right or wrong, the invalidation or validation level is very, very close. So, I would say at the end of this month, which obviously we still have 23 days roughly left in the month, 3 weeks. I would say by the end of this month, we'll know, is this a technical breakout or not? Because if we get a monthly candle close below those key levels, there's no denying it. It's reality at that point in time. And we see that along this way here with that blue support line, we never closed below it. We had some wicks below it. On the shorter time frames, we had some closes below it. But on the monthly, we never closed above or below this, with the exception of the actual throw over or failed breakout. So we're very close to key levels. And, if you say that essentially we were above the 200 exponential and simple since probably around 2011, you could argue that anytime we're above the 200 exponential or simple on the monthly, that bonds are overvalued, but in a positive uptrend, so people are willing to pay a premium for them. Well, once we're down below them, now technically they're trading at a discount. It doesn't mean that they're going to be trading at a discount and that's it, and then we go up again. It just means for the first time we've reverted to the mean, and now potentially bonds are being undervalued in comparison to their 200-month moving averages. So compared to their fair value over the last 200 months that they traded at, bonds are now officially undervalued. But we spent so much time above it, it's not hard to believe that we could spend some time below it and they could actually be, cheap compared to historical 200s. So at this point in time, we've gotten the hard sell signal again. We're crossing almost into the bearish control zone. We have all red histograms, red slope line. We're below the 0 line. The 8 and 21 have crossed to the downside. Again, the only thing stopping this from being completely bearish right now is the 200 simple has not yet flipped red. But if we were to close right here, right now, that would be it. I mean, we would flip it red. So we don't even need to go any lower. We just need to not go back above 116. So if we're at 113.67, that's also the previous low here from 2018, which obviously corresponds with the rates from our TNX chart. So again, we're getting ready to take out the previous swing low. So we really need to be paying attention to this, because each time along this chart, again, this one doesn't go back as far, but still to 2000, we know we've been in this powerful uptrend. And along the way, we have, basically put in a series of lows, then a high, then higher lows, then higher highs, then higher lows, then higher highs, then higher lows, then higher highs. And now here, we're potentially putting in our first lower low since the high. So at that point in time, eventually, this will find a bottom. We don't know where that's going to be. Maybe it's at our next support. Maybe it's where we're at now. So maybe we bottom at 100 temporarily at least. Maybe we bottom at 113 and we're already there. But then when we come back to the upside, what we have to pay attention to is if we put in another lower high, we're confirming further into this downtrend. I mean, we have a high, then a low, then a lower high, then a lower low. But that's just this descending channel that we've been paying attention to, this downtrend. But on the macro scale, when we start looking at the whole big chart, this is all just an eternal one portion of a move right here. Once this becomes external and we take out that previous low, then now we're looking at a macro downtrend potentially happening. And again, a 40-year trend might resolve a correction over 2, 3, 5, even 10 years. So we don't know how long this trend is going to be, but we know that after a 40-year time period of the same financial conditions or global conditions essentially affecting financial markets, we know that there's potential right now for something changing. And then when we look at the real world and we look at what's going on, it's obvious that we're at a potential inflection point and that we could see, what amounts to changes in the way the world works compared to the last, 40 years. So very, very important to zoom out on these things and really pay attention to what's happening. And then we have those clear, definable, validation or invalidation points. If you have a great strategy and you don't have validation or invalidation points, or you take a great trade, but you don't have, a stop loss or take profits, you're just basically winging it. And that's just not acceptable because it's not repeatable. If you don't have clear areas where you're going to say, okay, I'm right if this happens, or I'm wrong if this happens, and then you're able to validate or invalidate your theory, then you're basically just guessing at that point in time. So you need to have, in my opinion, clear, definable levels that you're paying attention to. And it's good to have more than one of those levels so that you're ready to react when something happens, whether you take out one of those levels or find support. So switching over to U.S. oil now. So we see, again, U.S. oil still creeping sideways, back up here at about 109. The key level we're watching is 114. If we take out 114, I think oil's going much higher. We are finding some support at key levels. We're trying to flip the slope back over. This looks okay for now. Just have to be paying attention to the fact that, here was our low back here. And obviously we had like that same low and we're forming this triangle pattern. In that amount of time, what we've seen is price has creeped back up almost to the bullish control zone on the indicator oscillators, but it's nowhere near that previous peak right here. So if we see this oscillator continue to just trend to the upside, you know, almost inside of the bullish control zone, our last peak inside the bullish control zone for the all-time high was 84, and we're essentially at 80 right now. So if this thing doesn't just start shooting to the upside massively, we're going to put in some bearish divergence between these points. And while I am still bullish on oil in the long term, I mean, we really could see an extended sideways period or a deeper pullback. As a matter of fact, I don't think it's unrealistic to think we come down here back into the 80s. So next we have the Dow Jones. Let's take a look at the major indexes and see what happened here. So we obviously had our weekly close on Friday. Sorry if anybody missed me on Friday. Also, I was extremely sick over the weekend. Feeling much better now, but still a little bit under the weather. But I was very, very sick. So for our Friday close, you know, we're slightly above the previous low. So we haven't technically taken out those levels, but we know the longer we spend down at this key support level, the more likely it is to break. So I do suspect this breaks. We also had I don't want to say we had a weak close on Friday because it was technically a green candle. But if we look at our close from Thursday, we basically gapped down, sold off, and then got bought back up. But we're still technically below the close from Thursday. So in all reality, if this was like a 24-hour market, this candle would start right here and it would be a red candle with a big wick on the bottom. But because markets are closed, obviously, you know, we gap down and then we move back up. So sure, it's a green candle, but it's another lower close. And it's lower than the previous ones inside of this internal move right here. The only difference is it's not lower. It's not the lowest close we've had yet. So while you know, even though we have a technical bullish rejection of lower prices here, even though we technically have a green candle on the Dow Jones, this still is a bearish candle to me because it's a new low. Even though we gapped down and got bought up aggressively, or decent amount, I should say, at least, or rejected at least lower prices, it's still a lowest low since, you know, this downtrend right here, this portion of the downtrend. So again, still a lower low, just not the absolute lowest low yet. But we are definitely in that danger zone. Dow Jones does not look particularly promising, although it does look better than the other indices right now. We are very clearly in a bear market, though, as we got rejected after the retest of the 200 exponential and simple. So, you know, a rational investor would say, well, we're putting in a series of lower highs and lower lows. We broke below the 200 exponential and simple. We retested them. Most people that had bought at that level or below that level will have sold into resistance of the 200 exponential and simple, expecting further downside. You know, so the real trade right here, or real play right here, is just be defensive and wait for an opportunity to buy in lower or buy into strength. And then next we have the S&P. So the S&P, again, closing a new low. You know what? I did want to look. Well, we'll just look at the S&P weekly. So closing a new low, not technically a new cycle low, as we were, you know, pennies lower previously. But we're at that level, you know, and we move below that level. We wick below that level. So again, same thing. We have a high, we have a low, we have a lower high. So again, we would expect a lower low, and we're just in the process of putting in that lower low, in my opinion. Now it's trying to, you know, we've lost the 200 exponential and simple again. Same scenario. You know, people are trying to get bullish and saying this is going to be the bottom right here and everything. But we're not seeing any signs of that on our longer time frame charts. Matter of fact, on the weekly, it's very clear that we attempted to cross 821 back to the upside and save the trend or reverse the downtrend that had started, and we failed to do so. And now our rejection has led us to lower weekly closes. So while it's not as clear on the daily, when we look at the weekly, we have the lowest weekly close since the peak. And at this point in time, price action is back at April 2021 levels. So, I mean, the S&P is one of the strongest indices. Obviously, the Dow and the S&P have been holding up very well in comparison to most individual stocks or other indexes or other countries' indexes. And we have at this point in time wiped out a year of gains. So if you bought any time in the last year, you know, the one of the safest quote unquote speculative investments, which is the, you know, basically betting on the United States economy, you're a loser. You lost. You're losing. Does it mean long term we won't ever put in new highs? No. But we're clearly in a downtrend. We're getting a hard sell signal on the weekly. We have all red histograms. We have red slope line. We're below the 8 and the 21. They're accelerating to the downside. We tried to push up last week. We see a clear rejection candle. It closed red. New low. I mean, that tells me we're going lower. We are going lower. That's what the chart says. 362 would be the target if we pull back to, you know, 200 exponential, 346 to the 200 simple. Obviously, they will keep creeping to the upside. But if we look back here and we see the previous high from the Rona dump, February 2020, we know that's right around 338, so slightly below the 200 simple right now. And then if we just turn on our fibs, we can see from the bottom of the Rona dump to the peak all the way up here, we're very close to touching the 236. And it just so happens the 236 lines up almost perfectly with the heart line of the channel, which, as a matter of fact, I can extend that a little bit. So we basically have the 236 right here, which is our, you know, potential entry for a bounce, as well as the heart line of the macro channel that we've been in, you know, literally for years. This is going back to our 2009 crash bottom, and we've been operating inside this channel the entire time. The majority of the time, we were in the top half of the channel, above the heart line or bouncing the heart line. When we sold off from the Rona, we came all the way down and actually penetrated the bottom of the channel. At that point in time, we reclaimed the heart line of the channel, and then we're back inside the top of the channel. Well, now here we are back at the heart line. So again, the majority of the time, you know, I can't tell you the exact statistics, but, you know, looking at this channel, how often were we below the heart line of this channel? I would say probably, what, 5% of the time? So it would make sense that we would find support around this key level at the 236. But it could, you know, we would expect it to be temporary support. We would expect a bounce, a pushback up, and a failure. We kind of already got the retest of that level that we broke down from. So it seems very viable that we're actually getting ready to go much lower. So, but we do expect some support around that level. So right around 400. But again, does not look particularly great. And if we just flip over to the monthly real quick, obviously we have plenty of time left on this monthly, but we are sitting at the 21. So we broke down from the 8 and closed at the 21. And now here we are sitting at the 21. Our last monthly close was a new low. We have a hard sell signal. We have all red histograms. We're literally sitting on support. So if we do lose this support level, there's not much holding us up. You know, and again, we're starting to really look back at that 324 level, which was the pre-pandemic top. You know, it seems crazy now, but that's basically our 50% retracement. Exactly, was that pre-pandemic top. So 50% retracement, which would also take us down to the bottom of the channel, which would also take us down to, you know, these key levels, somewhere around like 327, you know, seems viable long term for a potential bottom. Now, how many weeks or months or you know, does it take a year to get there? We'll have to wait and see. But at this point in time, we have some clear targets to the downside. And when we start looking at some of the weaker indices and stocks, like individually, we see many of the stocks are either at those pre-pandemic levels, or, you know, if they were, you know, IPO'd or SPAC'd in that time, they're below those levels that they, you know, publicly traded for. So these markets are looking very weak. IXIC, so if we look at the NASDAQ Composite Index, so we have hit the measure move to the downside. We did put in a new daily close. Again, looks much more bearish than the S&P and Dow Jones. If we look at our fib from the bottom of the Rona dump, we can see basically we violated 236, came back up, got rejected, and now we're coming down to the 382. So we're paying attention to that 11,570 level. We are seeing a hard buy signal on the weekly, or on the daily, I'm sorry. But obviously, you know, getting conflicting signals, as this is probably just going to see a rejection and then go lower, as this does look very weak. So I think 11.5 is a key area we're watching on this. But as long as we're putting in new lows, There's no reason to get bullish on this. And then if we start looking at the comparison between the fib and the moving averages on the weekly, the 382 fib is right at that 11.5 level, and that's also right around where the 200 exponential is coming in. 200 simple, slightly lower, right around like that 10,884 level, depending on how long it takes to get there, what kind of sideways price action we have, etc. Hard sell on the weekly, all red histograms. 821 rejection, going lower, still going lower. I mean, it looks very likely that we're coming back down. Again, we see the 0.5 is here at 10.4 and slightly above the pre-pandemic peak, which was right around like 9,700. So I don't think it's unrealistic. Maybe the NASDAQ has a deeper retracement and we come down to the 618. Maybe we find support at the 0.5. But obviously, we're headed to the 382 in the meantime. So those are the key levels to be watching. But we do see regular lower lows on the daily and weekly chart. And then for the Russell, again, very, very weak. So this looks very much like the Bitcoin chart right here. So we basically had a leg in or flagpole, and then we see the flag consolidation, which is again an ascending channel. And then we see the breakdown from that flag consolidation. And then we take out the low, next thing we do, and then we really start letting go. So the first move we're looking for is the measure move, which is from the top or the bottom of the channel, from the bottom to the top or top to the bottom from our breakdown, and that's going to give us our measure move, which we've almost hit. So we already almost hit the measure move of the breakdown of the channel. The next thing to pay attention to is basically you can extrapolate the move based on the flagpole. So oftentimes what will happen is you'll have a pole lead in either bullish or in this case bearish. So you can take that same flagpole, you can move it down to the breakdown, and then you can get the general velocity and depth of the move that we'll see take place. Now, it's not as scientific. You know, it doesn't have to be that exact amount. It doesn't have to be at that same pace. But on, average or statistically speaking, that's a decent way to set up a target as well. So we see the 382 is our next level down if we have just lost the 236, and that's at 1,725. So we're paying attention to the 382 next at 1,725, but the technical measure move based on the flagpole would put us somewhere closer to 1,546, which is the 0.5 fib retracement. And then if we zoom back here, we see the 382 was that pre-pandemic high. And also was the high back in 2018, slightly higher, but right around that level. So that's going to be a strong support because that was our 2018 high, that was our 2020 high, and then we obviously put in the aggressive Rona dump, came up, consolidated, throw over, distribution taking place, last point of supply, breakdown into our, bearish flag, and now we expect continuation to take us deep into, probably like the 1700s or, again, 1500s. But very, very weak. Very, very weak. No surprise here. And then if we just go to the weekly chart, again, we're just seeing extreme weakness on this. We're talking about how we're targeting the 200 exponential and simple on the weekly for some of our other indexes or charts. We have already reached that level on the Russell because this thing is so full of just absolute trash. Absolute trash. Just complete zombie companies. They should just change the name of the index to Zombies and Friends or something like that because it's just so much garbage. But at this point in time, it's not unrealistic to think we're coming down to the 200 simple. And, that puts us right in line with our other targets. So we're seeing a ton of confluence. We're seeing that same rejection. And we're barely, holding on to the 200 exponential for now. And we're closing lower weeklies. So again, just absolutely bearish. And now we're seeing the monthly chart. Again, we still have 23 days left in this month. But the 8 and 21 are about to cross the downside. Last time they crossed the downside, the market capitulated. It was a complete meltdown. The time before that, when it crossed the downside, not quite as bad, but definitely pretty violent. Time before that was 2007, going into the 2008 financial crisis. Complete meltdown. So, and then the time before that, 2000, complete meltdown. So, at this point in time, it's pretty reasonable to assume, there's a possibility we get something like this where we bounce back up, we save the trend, we continue to the upside. It's possible. It could happen. Hard sell signal, left the bullish control zone, all red histograms for 10 months at this point in time. Lost the slope line, flipped to a red, 821 about to cross the downside on the monthly. At this point in time, if you told me, hey, you can only bet on two outcomes and we either reverse this trend and start creeping back to the upside and everything's gravy again, or the 821 cross the downside and then we get a push down to retest the 200 exponential and simple? Which one do you think is more likely to happen? I mean, I got to go with the bearish scenario because everything is pointing towards the bearish scenario. So do we have to get down to 1,258? We don't have to, no. But if we see a similar move to what we saw, this is, keep in mind, this is, the pandemic levels, 2020 meltdown to the 200 exponential and simple. The time before that, this is 2008 global financial crisis meltdown below the 200 exponential and simple. And then this is 2000, obviously Y2K, the big boy, telecom bust. We basically came down to 200 exponential and simple. So in my opinion, that's the key levels to watch. Now, could we find support at a higher level, like 1350 or something like that? Could we overshoot and come all the way down to 1,000? Yeah, either one of those is a possibility. And there's going to be steps along the way. But at this point in time, I think that any intelligent investor or speculator or gambler is probably looking at this chart or many of the other charts saying, well, I don't know for sure we're going to reach these extremely low levels, but it sure looks a lot like it. I don't know for sure we're going to go into a situation, the equivalents of 2000, 2008, 2018, I guess falls into the cards there as well. I don't know for sure we're going to do that, but there's a pretty high probability. And again, we have never retested the 200 exponential and simple without the 8 and 21 crossing to the downside. We have crossed the downside, the 8 and 21, without retesting the 200 exponential and simple. So it's possible this crosses the downside and doesn't go to the 200 exponential and simple, but it's impossible that we ever go to the 200 exponential and simple without this crossing to the downside. So what does that tell me? Well, it tells me that if we cross this to the downside, the probability of hitting the 200 exponential and simple goes up exponentially. So it's worth really, really paying attention to these charts and these probabilities and possibilities, and protecting ourselves. Because like I said, if you look at it as like a car crash or something like that, and you say, well, every time I hit the brakes, I don't crash. So you can't say that hitting the brakes tells me we're going to crash the car. But you can say that, every time I've ever been in a car accident, I tried to slam on the brakes and it just didn't work sometimes, and then we got in a car accident. So what that tells me is you don't have to be scared every time we hit the brakes, but it's worth paying attention when we hit the brakes that the potential of the car accident goes up exponentially, because that's always, a prerequisite. I guess if you don't see a car coming or whatever and you just T-bone somebody, it doesn't have to be, but in this specific hypothetical made up example of an analogy, I would say that it's worth watching these levels. So Russell looking very, very weak. The stock market in general is looking very, very weak, and people are just now starting to legitimately accept this. So XLE energy, all right, so we're almost there. I know I was being a little nitpicky, saying I expected this to hit to 2.618, and we fell just short right here. Well, we're almost there now. So we're 1 day away. All we need is just slightly more upside. Energy obviously still looking very strong for now. XTN transportation closing the daily and weekly near the lows, very close to the lows. The last time we bounced was at 236. You guys know we still have targets down here at $68. Very, very weak. And transportation obviously one of the 4 horsemen. So, yield curve inversion and potential breakout. Transportation sector. We'll get to semiconductors. We just saw energy obviously has been spiking to the upside. So at this point in time, looks very likely as, again, all 4 of those things happened prior to 2008, prior to 2000, even prior to 2018. So we don't always have those 4 things happen and then lead us into a recession or depression or meltdown. But every time we've had a meltdown, those 4 things have signaled us in advance. They're leading indicators of a potential meltdown. So at this point in time, if you say, hey, what's the chance of a meltdown? Well, I say, well, we're getting a lot of signals telling us that the meltdown is likely to happen. And we're seeing a lot of things melt down already. So again, we don't have to have the meltdown. But every time we've ever had a meltdown, stuff looked just like it looks like now beforehand. So, and that's what it's all about. It's all about reading what the market is telling us and then taking advantage of that. And right now, the market is telling us we're looking like we're about to have a meltdown. Could something change? Government policy, monetary policy, fiscal policy, war ends. I mean, sure. Aliens come down and give us some great, technology. Sure, anything could happen. But, I mean, what's the probability? in my opinion, I would say, do I think the war's going to end anytime soon? Probably not. Do I think aliens are going to show up? Probably not. Do I think the economy's in great shape and all of a sudden everything's just going to turn around and just start shooting to the upside? You know, even though last time it took $10 trillion pumped into the system and given out to, you know, taxpayers in just a couple of months period just to get that pathetic move that we're slowly giving back. I mean, unless they bust out another 20 trillion, I don't think we're going higher anytime soon. That's what the charts say. XLF looks terrible. Financial institutions. Just saw like a article recently about how people are just completely confused by financials, why they're underperforming, why they're in a bear market, why they're trending to the downside. Well, I mean, we've explained it, 20 times. Not going to do it again, but they look terrible. And they're going to continue to look terrible because this is a horrible environment for financial institutions. So, absolutely terrible. Absolutely terrible. And long term, I'm even more bearish on financials because I really do believe in blockchain technology or some other form of, payments, service, transaction, etc., disrupting the space. And we've already seen over the last few months, banks probably aren't that important anymore how they used to be. I could honestly see a future where, maybe 90% of banks go away, or at least public locations, physical locations. XLV is next. So healthcare, obviously retesting some lows, looking a little better than most, but we are confirming into the bear market officially for the first time. In the previous sell-off, we did not break below the 200 simple and have it flip over red. Here we see the 200 simple has flipped red. 200 exponential is red, and we're below both of them. So while we are in the bearish control zone, trying to trend back to the upside, we are actually confirming into a bear market for the first time on healthcare. So this is definitely a defensive play and probably why it looks okay compared to most of the other charts, but doesn't look good. XLU, again, safety, defensive play. Looks better than most. Still above 200 exponential and simple. Still looking okay. Found support at that key level, our yellow support line here. So as far as I'm concerned now, this thing probably just chopped sideways for a bit. Probably one of the better charts we've looked at today. XLP, consumer staples, again, much stronger than most. Came down to that key level in yellow right here. Found some support. We're kind of hanging out for now. We broke down from the key ascending resistance turn support. Did not hold. We retested it and got rejected. Looks like we're headed down here to the probably to like the 73, 74 level to retest 200 exponential and simple. And while we do see weakness in this, again, this is a defensive sector. So, these four sectors that we look at here are defensive. And then, obviously you can count dividend stocks, or in this case, honestly, most of the energy stocks are sort of our dividend slash safety slash appreciation stocks. But if you have a dividend portfolio, people will tend to allocate more towards dividends in a slowing period. XLRE, real estate sector, obviously showing some weakness. Mortgage rates, home starts, days on market, inventory, available supply. I mean, we're seeing a lot of structural weakening in the housing market. And we've talked about this many times over as well. One of the things that's going to be a big for each person that lives in a house, say everybody owns just one house, hypothetically speaking, or would own one house if they can afford it. But nobody has multiple houses. People aren't buying them to invest, whatever. When you leave a house, you go buy a new house and then you live in that one. Maybe it's bigger, maybe it's smaller, etc. But the demand comes from people leaving a house and then buying a new house. So they sell one house and they buy another house. So that doesn't really change the inventory on the market as long as they're selling their old house. And then obviously a lot of people have never owned a house that are renting, and then they save up and then they buy a house. So again, that affects the rental of the house they used to live in or apartment or whatever, but then it takes one actual house off the market as well. So in those scenarios, one affects supply and demand, and one only affects demand. Because when you leave an apartment that you're renting or a house that you're renting, it doesn't affect the supply of houses for sale. As where if you're selling your old house, it does. The same way that, say you're, somebody that lived up in New York or something like that, and when everything went down and everybody's working from home and all the craziness, you bought a second house in like Florida or something like that, and now you're bouncing between the two houses. So again, that's a similar scenario, but now when you bought the new house, again, you affected demand by demanding a new house, but you didn't affect supply because you didn't sell your old house. You now have your two houses. So we've seen more things affecting demand and not affecting supply in the same way, relationship percentage wise, that we would normally see, because people are keeping a second house, because some people are selling a house and buying a new house, and because other people are leaving, a rental going into a purchase. And then on top of that, we have institutional investment taking place as well, where people are starting to invest in real estate instead of stocks or bonds or something like that. And I say start, but obviously it's been going on for some time. But we heard a lot about it during this housing boom and everything. So the reason I, state all those points is because all of those things, with the exception of the person leaving an apartment or family leaving an apartment or a house or a rental and buying a house, all of those things affect supply and demand differently. And only one of them, when someone sells a house and then buys a new house, is actually putting new supply onto the market. So if we see a change, like the housing market starts to flip, and then we see a lot of people selling their second homes that they were otherwise not selling, well, now we have an acceleration back to the downside as, people think, oh, the market's getting kind of toppy, or maybe I don't need that home, or financial conditions are getting tight. Let me sell that second house. Or potentially investors start selling houses because they don't want to go upside down in them. Or potentially we see more supply coming online from builders or people that were previously renting that are now going to sell their house because they don't want to have to worry about, the government saying someone can live there for free for some indiscriminate amount of time. So the fact of the matter is, we saw a bunch of things, pulling on one side of the supply demand curve, and it was all pretty much one-sided. So that was, in my opinion, and then on top of that, obviously the lowest rates historically ever for a mortgage. When you take all those things and put them together, it makes sense that we're not going to see that same strength going into the future. We're not going to see people that bought a house with a mortgage at 2.5% going out and buying a new house with a mortgage at 5 or 6 or 7%, because you can't transfer that mortgage. You have to go out and get a new rate. The buyer doesn't get that mortgage. It's a whole new deal. So that being said, a lot of those people are going to be incentivized not to sell, not to move. So they're just going to hold their houses. So they're going to no longer affect the supply demand in the same way that they previously did or would have. And then a lot of institutional investors, if prices start to drop, or people that own a second home, all of a sudden, maybe they had this home forever. They got a new home with a super cheap mortgage rate, and they kept their old home because it was already paid off, or, whatever the situation is. If all of a sudden the values start dropping, they decide to sell that other home back onto the market. That's not affecting their 2% mortgage on their new house they bought. But the value may be going down on that after it went parabolic. So they think, we'll just get rid of that second home, etc. More supply comes onto the market. And then on top of that, we have less demand because the banks are approving less people for a mortgage. Less people want a mortgage because the rates have gone up so much, or they're not willing to get rid of their old mortgage. So we have all of a sudden an inflection point in the supply demand curve for housing. And it's realistically just a matter of time, because over a long enough time frame, we're going to see more housing supply come online. Over a long enough time frame, we're going to see people that have, we don't have the same like adjustable mortgages problem that we had previously in like the housing crisis 2008. But essentially, every day there's people whose mortgages are re-rating. So maybe they had a 5-year period locked in, and it was from 2017. So now they have that 5-year period resets, and then it resets at like the current mortgage rates. And we're going to see that continually happening over time into the future. A lot of people that just got, a new mortgage might have a 5-year period before it re-rates. So they're fine. They got it at the lows at 2 point something percent, and they're not going to need to refinance or re-rate the mortgage rather until like 2026. but there's a bunch of people that refinanced previously that are going to be coming up on that time. So now we're going to see these mortgages re-rating, and all of a sudden people can't afford the houses that they've lived in. Now, because they bought a few years ago, because there was so much appreciation in the market, because they've been making payments this, last 5-year period or whatever, maybe their mortgage goes up, and now all of a sudden instead of $2,000 a month, it's $2,600 a month, and they can't afford it. At least they can sell their house and get enough money to pay off their loan and then move somewhere else. They're not going to be upside down to where they're getting foreclosed on, but it's still a bearish scenario for housing going into the future. And we're going to continually see that pressure. And until mortgage rates get down back below, 2.5% or around that level, we're not going to see demand coming back online for like refinancing. So we basically have, in my opinion, we've inflated the bubble as big as it can go without some crazy, crazy change. And I don't see that happening anytime into the future. So I'm actually very bearish on real estate looking forward as anything other than basically like cash income. But, previously you could buy into real estate as an investment. And, because it appreciated as fast as inflation or faster, it wasn't a bad investment because it at least held your purchasing power or became more valuable. That may not be the case going into the future. It's the same thing with cars. We saw an anomaly in used cars where people are basically selling their cars back to dealerships or to third-party sellers for more than they paid for the car a couple years before after driving it for 10s, 20s, 30,000 miles. And all of a sudden it's worth more. That's not a normal scenario. A car and a home are both technically depreciating assets. So you would expect over time with upkeep and, age, that the value of them would go down. It's only this weird anomaly that we've seen happening recently in the car market that can help us put into perspective what's going on in the housing market. And the truth is, functionally, that's not how the markets work. So I think it's realistic to think that we do actually see, this potential meltdown about to occur as we do flip into a bear market for the first time in real estate. And again, this is going to act with a lag. So maybe this takes 2 years longer than the stock market does to bottom, but I suspect we're headed lower. Much lower. So VWO is next. Vanguard Emerging Market ETF. So we revisited the lows. We took out the low. So we have a new low on this. And again, looks like it's going much lower. We're almost to the 0.5. That was our target to the downside. I mean, we're technically in the green box, but $41 was our potential support area. And then again, if we just flip to longer time frames. Oops, that's not what I meant to do. Flip to longer time frames and we take a look at this thing on the monthly, absolutely horrendous. We're basically at the 200 exponential and simple, but everything is not only going to the downside, but accelerating to the downside. And I don't want to rule it out at this point in time that we blast and come all the way back down to like 36, 35. That's our like real macro target to the downside, but very, very weak. Very weak. Got to be really careful with where your money is invested right now. Especially with all this dollar strength we see taking place, DXY. So DAX is next, holding up okay for now. We did take out the little swing low right here and come down lower. So at this point in time, it looks like we're going to come down here and revisit the lows. Best case scenario, this holds around the 236. We get that potential entry point and the retest of 200 exponential and simple because that will give us a higher low. Don't want to get too excited on this just yet, but that's the scenario we're paying attention to. Germany also just has so much going on right now. It's like the last place I really want to put my money. CN50, so China, obviously looking very weak. We are still technically above. We have a low right here from mid-March, and then we have a low right here from the end of April, and then now here we're threatening that low. So we want this level to hold for a potential, higher low scenario. If it doesn't hold, we expect to revisit the lows. Eventually, this thing's going to try to push back up and retest the 200 exponential and simple. But until the 8 and 21 cross back to the upside, every other time it's been a fake out. We try to push up here, can't cross back to the upside. Try to push up here, can't cross back to the upside. Can't cross back to the upside. So nothing telling me this trend is about to reverse. Still just going down. So when we see the 821 flip green, then we can potentially look for that trade setup for, what amounts to the reversion to the mean, retest for 200 exponential and simple. And then we can pay attention to what this is going to do going into the future. UK 100, so we're seeing that weakness come in. It did break back down below the yellow. We're at the 200 exponential and simple. I've said it countless times, but this is stronger than most. We retested 200 exponential and simple countless times. This one is like the anomaly that broke down past it, and then it tried to bottom, put in a lower high with bearish divergence. So would not be surprised. It looks like it's coming down to 7,100. Would not be surprised if it came all the way back down and retested the 382 lows. But this is really looking like a double top scenario. And depending on how you want to look at this chart, how you want to look at this pattern, the key levels to watch are basically right here at the 200 exponential and simple, at the 236, and then at the 382. So those are our next like 3 steps to the downside. And then bullishly, I mean, if we can just keep consolidating above the 200 exponential and simple, eventually put in a new high, but it doesn't look like that's what's going to happen. EWZ, Brazil. Again, blasted through the 200 exponential and simple. Looks like we're headed down here to our target. So I'm going to pay attention. Going to keep watching around 29 for this to hit our ascending support line. That is our, what we would expect to be just another higher low bottom, and then eventually a push all the way back up. So the trade setup on this is already in play. So we can just use that one. So when we get down here to that level right around like 30 or so, that's where we're looking to enter. And then, a tight little stop loss. Obviously, just want to make sure that we're not taking out this previous low. But our target to the upside is just going to be a retest of that fib level. And we do expect it to go higher. So we actually have, so we have a couple of trade setups in play. One for 38%, one for 55%. Just looking for it to come down a couple more dollars and get to our entry. Doesn't have to go that low, could go lower. So, we won't want a strict entry exactly at that point, but we're looking for like bottoming signals around there. We're obviously getting a hard buy signal, leaving the bearish control zone, but we're still seeing weakness on the histograms. We're breaking down from key levels. I think more likely than not, this thing kind of just chops down and slowly moves lower over the next like few days or weeks. And then if we look at the DXY, so we see here again, new cycle highs. So we basically closed here, had a small retracement, came up here, new cycle high basically, or same. Very, very strong. DXY is still extremely strong. We do see the sell by sell. The spacing is a little bit awkward, but still got to respect this. So need to be very careful. But until this leaves the bullish control zone, which we're still very much up here in the 90s, until we cross down below the 80s and lose the red highlighted background, we have no respect for the signal, because we need the sell signal to correspond with leaving the bullish control zone. Otherwise, it's basically just chop, and we can easily just float higher on bearish divergence until eventually it plays out. But still very, very strong. And on longer time frames, I mean, this thing, we've looked at a million times. It's extremely strong. Here's our weekly, just absolutely crushing it. We have now, at this point in time, taken out, we've been watching these levels for, years now, months, realistically, talking about them. So since we put in our double bottom here, the March Rona high was the previous high. We took that out. We smoked it. And then the 2017 previous high, took that out. We smoked it. So when we zoom out here now, I mean, what's left? We just took out the high. We just took out the highest high we've seen since 2002. So we are at a 20-year high on dollar strength. 20-year high. So I guess that's the top, right? Because we're at a new high, so that has to be the top. I mean, probably not. Probably this thing is just going to keep ripping. Does it put in a lower high than the previous peak back here in 2001? Does it put in a lower high than the previous peak in 1985? Yeah, it probably does. But we're looking at a chart right here going back to 1968. And we know that when the 200 exponential and simple on the weekly crossed the upside, we went absolutely parabolic. We went absolutely parabolic, but to a lower high. We went absolutely parabolic, but so far to a lower high. But there's not a lot of resistance from where we're at right now and where we're potentially headed. And when I turn on the crazy chart, we know obviously our target is that descending channel resistance, which is somewhere up here around 110. And that is my target to the upside. That's where I think the dollar is going, 110. And we see that corresponds to basically this peak right here and potential peak right there. You can't see it as clearly on this chart right now, but we have our low down here and our low down here. And then we obviously have time cycles in play as well. But when we switch over to our monthly chart, it all becomes so much more clear. And then we can look at, essentially our macro fib from this peak to the macro low, from this peak to the macro low, and then we can extrapolate that over here and see we just took out the red 618 level. So, I mean, we'll have to see. But, I mean, I think our target to the upside is still right around that 110 level is what I'm really paying attention to. I mean, this is very strong. Very, very strong. And again, we saw with the 200 exponential and simple cross to the upside here, 200 exponential cross, but never flipped the slope on the 200 simple. And now here we see the 200 exponential and simple, both slope to the upside. And again, you know, that would have happened somewhere around here previously. And then we went parabolic afterwards. So it makes sense that we would come up here, you know, to like that 110 level, put in another lower high, and then we'll see where it goes after that. But very, very strong. DXY is very strong right now. So Tesla back down here below 900. We said the 900 level was what we were paying attention to. We came down to it, kind of chopping sideways, holding some key support below the 200 exponential and simple. Again, looks like next target to downside is 770. You know, target back to upside around 1100. We're below key resistance though. So if we can't get above 900, you know, you can't get bullish on this. 200 exponential above it right now. So it looks like it wants to go lower. Retest that 768 level. Looks much better than most things right now though. So Nvidia putting in new lows down here, continuing to grind down under 186 now. So 175 is our next target to downside. Still very much in a downtrend, very much in a bear market, and a great proxy for the semiconductor space in general, as it's typically one of the strongest. But I mean, we could look at any of them, Marvell, you know, Micron, AMD, any of them going to give us basically the same thing. And then you have some that are, you know, even more weak, like Taiwan Semi, etc. You know, rightfully so, obviously. So Apple is next. So we did see Apple break down below 200 exponential and simple. We did see a 200 exponential flip bearish. 200 simple is still positive for now, but this is looking pretty tired right here. And we essentially have a high, then a low, then a lower high. So we have to look down here at the lows and expect Apple to retest around 150. So that's what I'm paying attention to now. It is trying to make a short-term bullish move. So Microsoft was very strong, you know, for the last few years, and is showing some definite weakness now, confirming into a bear market. You know, basically at the lows right now. So a breakdown from this level probably will take this much lower. Much lower. So we have basically a macro head and shoulders that has formed. Clear topping pattern. Played out perfectly with the 618 internal retracement of the leg down. And now here we are at support. So if we break down from this level, our head and shoulder measure move would take us down roughly the 0.5, somewhere around like 220. The 382 is our next main target to downside, as we have already lost to 236. So the 382 is about 241. That's what I'm paying attention to. And that's just from the Rona dump to the high, which is, in my opinion, this should be on every single chart that we draw. Every single asset that we analyze should have this exact tool on here. We should have our Fibonacci in place from the Rona low to the, you know, all-time high or cycle high, depending on what asset you're looking at. And then we should really just be watching those key levels, because at this point in time, I mean, it's hard to deny that we've topped. We've already taken out the 236 on just about, you know, any stock, let alone most of the indexes or some of the indexes as well. So the next target has to be our 382, and that's really what we need to be paying attention to right now. And then within that, we can pay attention to all the other things, you know, that are presenting themselves. But the 200 exponential and simple moving averages right now are very, very important. And then the Fibonacci levels. So that's what we're really watching. You know, and when we switch this over to like the weekly and monthly, we can see obviously why some of those levels are so key, as they all line up and give us confluence. So Amazon did hit the measure move. So we got the measure move for the channel break on the last couple daily candles. Very nicely done. It's a good little Amazon bitch. So 382 obviously has been taken out aggressively. We tried to retest it and it failed and rolled over. So obviously the next target's a 0.5 at 22.23, which again is basically, that's the 0.5 level. And then the high from pre-COVID levels is 2000. And that has been our macro target for months and months. I did not think, I mean, I shouldn't even say months. I didn't think we were going to get there this quick. I'll tell you that much. But I mean, at this point in time, none of this surprises me. So We're still going to watch this level right here. That's obviously our key level for I would expect a very strong bounce from that level. As it did act as resistance quite a few times. So when we come back down to it, it should act as support. And obviously nice round number 2,000. And then if Amazon does a 20-to-1 stock split, we're getting Amazon for $100. I've been talking about that scenario for a while now. Fully expect that to happen. Fully expect it to happen. So we'll pay attention. Maybe we don't get there though. I think 2,200 is probably a decent entry for a potential scalp play. But again, I'm not trying to pick bottoms on these things. And Amazon has a lot of headwinds going into the future as well. We're seeing a decent amount of spending from the consumer as far as like travel and vacation and eating out. But we're not seeing as much for like, retail, online retail, or higher end retail from the consumer lately. Netflix obviously melting down, new low, complete trash. No surprise in anyone's mind, as I've been calling Netflix trash for literally months. So we're at that 180 level now, completely wiped out, almost 5 years worth of price action. So if you bought Netflix anytime in the last 5 years, you are a loser. Not if you bought their service though. As long as you enjoyed what you were watching, then you're a winner. But if you invested in the company because you thought Netflix is going to be huge and is constantly growing, well, hopefully you sold sometime in the last 5 years, or else you're a loser. And you know what the worst part is? It's going lower. So if we come down to my target down here at the 382, which is 123, that's 2015 August levels. So if I'm right about Netflix and it keeps melting down, if you invested in this company anytime in the last 7 years, you would be a loser. You would be upside down on your position. What a trash bag company right here. What a trash bag company. Complete garbage. They had the market by the horns and obviously did something wrong. They wasted a ridiculous amount of money. That's what it really comes down to. Think about how much more profitable Netflix would be if they weren't paying, big stars millions and millions of dollars to make some Netflix exclusive, mediocre at best movie. Absolutely horrendous plan. This is what happens to companies though. They have a great plan, a great business, and then they fail to make good decisions, and then eventually their business turns to garbage. The competition is just popping up left and right, and obviously Netflix is getting slayed right now. So Google broke down below the 236. That was the key level we were watching initially. Now we have a 382 target down here. Again, this should be on literally every single one of your charts. Every asset you look at, you should be putting this fib level on your chart, and you should be watching the 200 exponential and simple. The relative to each other, is the 200 simple above the 200 exponential? Probably weakness. Is the price action below the 200 exponential and simple? Weakness. Are the 200 exponential and simple slope to the downside? Bear market. And as long as we're seeing bear market, I have no interest in entering into these things or trying to pick bottoms. We can take some scalps and maybe one will end up being the bottom. But when I buy into a stock that is melting down, I'm buying into it, expecting it to go lower, but trying to take advantage of a potential trade setup for some quick gains. But, like I always say, we're in, we're off, we're out. We're going to get that nut and then keep on moving. We do not want to be accumulating things that continue to melt down after we accumulate them. Because sure, if you buy something when it's down 20% and then it goes back up 10%, you're like, I'm a genius. And then all of a sudden it goes down another 20% and you're upside down on your position. You don't feel like a genius much longer. And the truth is, some of these things have a way to go. So the 382 on Google, the old alphabet, again, 2,000. So it would not surprise me to see Amazon and Google both at $2,000 in the next month or two from now. Now, will that be the macro bottoms? I don't know, but would not surprise me in the least bit. And keep in mind, these are all the super strong stocks that have been holding up this market. Well, some more than others, but Amazon and Netflix have not been that great. But there's still a big portion of the index. So Facebook next, Meta. Obviously, just looks so weak. Such trash. Holding that key support, though. We have the ascending broadening wedge. We broke down from it. We reclaimed it. And we're still above it for now. As long as this level is holding, it looks okay. But again, look at this. From, that was our low. The Rona low. And we already took out 618. We almost made it to the 786. I mean, this is terrible. The 786 is like the deepest retracement you want to see for something to reverse and go back to the upside. So if everything else is just now getting heavy, or a lot of other things are just now getting heavy, this probably has a lot more downside. And I mean, at that point in time, we're talking about taking out the potential Rona lows. I mean, this was a 2018 Rona low. We're now still below the previous high prior to the Rona dump. I mean, this just looks absolutely terrible. I would be very, very careful in some of these, were winners that are just trash now. So let's check out our crypto next. Hey, appreciate you, K. Ols. Good to see you. Loud and clear. Yeah, I saw it a little bit ago. I should have said something, my bad. But thank you. I appreciate that. Make sure to smash up that like button. So Bitcoin futures chart. So now a lot has changed here. We obviously saw a little gap down on the futures chart. At this point in time, we have our close right here on the daily chart, basically at the previous levels from January 25th. That was the key level we were watching to break down from that. We broke down from it here. We haven't technically closed there yet. So I think realistically, the daily close below that level is what we're paying attention to. So a daily close below 35,545 looks very bearish because it's a new low. And then at that point in time, the only other level to really watch is back here at 30K, which was the low before the Rona high. But remember, regardless of how you have the count for Elliott wave, whether this is the retracement, whether this is the top or this is the top, whether this is, expanded flat, etc., regardless of all that, the fact of the matter is this is the highest high. So we have a high, then we have a low, then we have a higher high. So we need this to be a higher low to continue the uptrend. So if we take out this level on a close, that 29,455 level, if we take that out, regardless of how you have this charted, no matter what, we are no longer in an uptrend because we took out the previous low right here. So then that's on the macro looking at this chart. But then when we look at this, we have a high, then we have a low right here, then we have a higher low, and now we're potentially putting in a lower low. So we have a down firm confirmed right here, and we're no longer in an uptrend if we take out 30K. So the downtrend is pointing us towards 30K. And then if 30K holds, that will look okay. It's going to look a lot like a double top, though. It's going to look a lot like, basically this is a atom, a sort of like sharp V. And then this is an eve, a sort of just like rounding top. And it's just a double top pattern of distribution. And then potentially, if we break down to 30K, and then if 30K doesn't hold, we now have a serious level violation. And then if we drop down from 30K, I mean, there's no real support till 20K. I mean, this is 20K right here. That's 20K. That's previous all-time high. Obviously, that's a big deal. This is a daily chart. I mean, we have, like 2 weeks of price action between 20K and 30K. So there's no support. And part of it is a gap that we never filled. So, we see a gap here on the futures chart in the middle of the no support zone. I mean, there's nothing here. There's, 3 days worth of candles, and then we have a gap, and then we have like 5 days worth of candles, and then we have, 2 days up here basically from that 20K level. So there is no support below 30K. It's basically just an air pocket. So again, 30K needs to hold. Now also 30K is where Michael the Failure Sailor has his Bitcoin positions with MicroStrategy now. So there's going to be a vested interest in him and a lot of his, Bitcoin buddies trying to hold that level. So we know he's already levered up against his Bitcoin position. So he has literally given up custody of MicroStrategy's Bitcoin in the form of, rights. The same way that you basically use collateral to take out a loan. And if you have issues with that loan or paying that loan, the bank can potentially take your collateral and liquidate it. So again, he didn't take out massive leverage against his $1 billion Bitcoin position. But right now, his average Bitcoin price is like 30,200 or something like that. So he's 10% up on his position, and the millions and millions, the hundreds of millions of dollars that he has borrowed that he has levered against his Bitcoin position are all upside down. So even though his average price is technically okay, sure, he had $1 billion position and then he borrows 200 million and then he buys 200 million worth of Bitcoin and then loses immediately 10, 20, 30% on that. So now his borrowed position is upside down already. His whole macro position for micro and macro strategy is almost upside down. So this is a very, very powerful level, because I'm going to tell you right now, when that $2 billion position goes down to 1.4 billion, goes down to 1 billion, and then all of a sudden you're upside down, and now you're 900 million, now you're 800 million. What's that going to look like on MicroStrategy or MacroStrategy, when they have to report and they have to mark down all that Bitcoin also as a massive loss on their balance sheet? So now you have MicroStrategy and, the split off MacroStrategy, already looking like trash. And then they're going to have to take a massive loss of hundreds of millions of dollars when their Bitcoin positions are, mark to market. It's going to be a death spiral. And then, who knows? Maybe Michael Saylor has to start selling, or maybe he decides to sell. Maybe he starts doubting his own case for store of value. Maybe Michael Saylor teams up with Peter Schiff and uses his Bitcoin to buy some of that stiffy gold. Oh man, would that be a real... I can't even imagine. Can you imagine what the interviews and the articles would look like? Michael Saylor capitulates, sells Bitcoin, buys gold? What? I'm not saying it's going to happen, but, if you've ever listened to Michael Saylor's interviews, he went into this whole long thing about how he was planning on buying gold, and gold was going to be the thing of the future, and that's what he was going to invest in. And then he finally changed his mind and decided to buy Bitcoin. But before that, when he saw Bitcoin, he thought it was a scam. He thought it was trash, blah, 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 blah. So we know he's flip-flopped before to Bitcoin. So let's hope he doesn't flip-flop against Bitcoin. Because if all of a sudden that $1 billion in Michael the Failure's position goes from a macro buyer to a macro seller, things could get pretty nasty on the Bitcoin chart. Things could get pretty nasty, especially with a big old air pocket. I'm just saying, I've been saying it since the beginning. People are trying to call Michael Saylor Bitcoin Jesus. And I'm like, no, you're mispronouncing that. It's pronounced Judas. He's the Bitcoin Judas. So that being said, Bitcoin looks like trash. Looks worse. Literally every time we look at this chart, it looks worse than the last time we looked at this chart. So I would say downtrend. Bearish. So we see the Bitcoin Bitstamp chart, obviously, just melting down. 200 exponential and simple have flipped bearish. We're in a bear trend. We tried to retest it. We tried to get out of it. It failed. We're at the lows. We're breaking down from those lows. We have a new daily close low. So what we haven't done on the spot markets, we already did on the, what we haven't done on the futures markets, we already did on the spot markets. So, I don't really count these wicks for anything right here. I go by closes. Daily close wise, we have a new daily close. So now the level we're watching is 30K. 29,500. That's our lowest low close of this entire cycle. And that was before we put in our highest high. So again, looking like a macro, massive double top distribution pattern taking place. Getting ready to just completely destroy the, what are they called? The cyber hornets are about to just get raided bad. Or not. Or maybe we bottom here. But doesn't look good. Weekly chart looks terrible. We have 2 weekly candles below where we're at right now. And then after that, it's just a retest of the 200 exponential at 27K. Just a retest of the 200 simple at 22K. We're just going to fill a little air pocket. Just going to come back down here to the previous all-time high, 2020. Or, 20,000 rather. It looks terrible. All the indicators, all the oscillators, everything looks absolutely terrible. And then here, when we look at our monthly chart, we see the monthly chart has broken down from the 21. Again, the monthly is currently at the low. If the monthly closed right now, it's the lowest low close on the monthly. We have wicks lower, but this would be the lowest low close. Now, obviously, we still have a few weeks till this closes, so, we don't have to worry about that quite yet, but it doesn't look good. And, we're below this level. The last time this happened, was basically our capitulation, 50% move over 2 months. Here, we saw a similar situation happen. That was that, Rona, quote unquote, black swan event that we somehow were able to identify and get out of the way of and take advantage of. I guess just luck. Looks terrible though. Hard sell signal. Stochs are accelerating to the downside. I mean, they're getting faster and faster. The blue is getting further away from the purple. That means not only is this chart bearish, it's getting more bearish by the day. And then obviously we have a double top, bearish divergence on the weekly, bearish divergence on the monthly, and then all red histograms for, at this point in time, 6 months of red histograms. We are at a key level where we technically would see a bounce though, at the slope line, right around like that 34.40 level. But I mean, what is that going to be? Just a bounce off the lows right here, and then a retest of the 21 as resistance. And then if the resistance holds, we just go lower. Just the Bitcoin chart looks absolutely terrible right now. You have to be really, really careful in these markets. I mean, let's be real though. We all know. we all know. We've seen this coming for a while now. Ethereum chart, again, retesting the lows. The big area to watch on Ethereum is going to be like, 24,000 roughly. And then after that, it's much, much lower. 1770 was the low. So Ethereum is holding up technically better right now. But when and if this lets go, Ethereum is going to get wrecked. Because for that same 10% move on Bitcoin to retest the lows is another 32% to the downside for Ethereum. So if this flips bearish, if this goes bearish, continues bearish, Bitcoin goes down 10%, Ethereum is looking at a 30% dump just to get to the same level. Just to get to that next previous support, I should say. So got to be real, real careful with something like Ethereum if it decides to break the downside. Bitcoin dominance chart, again, just chopping around that same level. Looked bullish there for a little bit. Then we saw a pretty bearish candle come in. Hard sell signal. This is on the weekly. We're just chopping around in the middle of the range. Descending channel with bullish divergence. I do expect this eventually to break to the upside, but it's just chopping. Total market cap chart just looks the same. So we're down to 1.5 trillion. We were saying it at, 1.8 trillion or 1.9 trillion? If we didn't hold that level, see at 1.5, well, here we are, another $500 billion in fake crypto value wiped off the face of the earth. $500 billion. So a quarter of the crypto market just evaporated in the last couple weeks. A quarter of the crypto market evaporated. Poof. Poof. Surprised? Not me. New low on the weekly chart. Obviously the key level we're watching now is 1.28 trillion. So, hey, see at another 25 trillion carved off the top. Or another 250 billion. Yeah, that sounds right. God, these numbers are so ridiculous. They don't even sound real. So Matic USD broke down from key levels, holding the descending channel or support for now, headed to the 0.5, as we've been discussing. So 92 cents. We were unable to hold the dollar level. That was a key level. So it looks like 92 cents. And I would expect that to hold at least temporarily. But what's going to happen, maybe we get a push back up to like $1.20. Quick little like 30%, 40% rally. Got to be real careful with these alts. So Avalanche, AVAX. So this one actually put in a new low and retested. Now this is a Coinbase chart, so it doesn't have the best history, but it retested the low. So remember, I use this analogy quite a bit, but let's just say that you're some pleb on Coinbase and you decide, hey, I'm going to buy into Avalanche. It seems like a good idea. Anytime since it showed up on the exchange, any day, pick any day since it was on Coinbase, and you say, I'm going to buy into Avalanche. No matter what, 100% chance you are a loser. You have lost money. This is garbage. It's trash. So you bought into it because of some fake dream that it was going to be good or useful or take over or whatever. Well, regardless of what you believed, you and everyone else on Coinbase platform are losers now. So is it going to be easier for this price to go up with all the losers trying to sell every time it goes up? Or is it going to be easier to go down with all the losers deciding, F it, I'm out. This thing's trash. So it's going to be very, very difficult now for Avalanche to do anything bullish anytime soon when everybody that's ever bought into it on this entire exchange is a loser. I mean, if you use Coinbase and you bought Avalanche, you're a loser. And even if you didn't buy Avalanche, you might be a loser. I mean, who knows? If you're using Coinbase, probably not making good decisions in your life to begin with. So Solana, again, complete and utter trash. I mean, absolute garbage. Just completely melting down. New low. This is our key level. We're at the low. We technically put in a new low by the wick. You know, we've been talking about this one too. You know, if this thing breaks down here, there's not a lot holding it up. I mean, this went parabolic over like a 5-day period from like $44. So we're at 76 right now. I would not be surprised to see this melt down 40% very, very fast. There's 2 days worth of, you know, buying action. This looks absolutely terrible. Man. I mean, I feel sorry for anybody holding bags of some of these like trash coins. You know, and maybe one day Avalanche and Solana and Matic are all going to be great. I'm not saying they're not. But right now, they're obviously utter trash based on the charts. Next started to downside 618 at 53. And then the 786 is at 34. You know, there's some support here around like 40 or so, 44. But this thing, I mean, I would be really, really careful in these markets because this reminds me exactly of 2018. There's a strong argument that all these cryptos could literally drop 25 to 50% very fast. Now, does it have to happen? No. It does not at all have to happen. We could go bullish tomorrow and go back into an uptrend and, you know, new highs for every crypto. All of them. Come rocket to the moon. Safe moon, on fire. All of them just start crushing. But I doubt it. The charts aren't telling us that. XMR, Monero, reclaim the 200 exponential and simple. It's holding on for dear life for now. Got to be real careful with this one, though. It's holding on for now. So as long as it consolidates here, this is good for it. I think the longer it goes sideways here, the better it looks. Long-term chart on Monero does not look good. So the algo setup. All right, so we were looking at this algo setup. And again, you know, obviously, crypto looks like trash right now. But for whatever reason, algo looks good. So we have a clear, you know, descending wedge or channel or whatever you want to call it right here. Depending on how you look at it, you know, we're at the level of a potential breakout or arguably, you know, breaking out right now. So if you went a little more like a channel, it probably looks a little more like that. If you just go by closes, I think technically we've already broken out. We're consolidating here. A measure move. We have a, you know, trade setup in play right here. 32% potential upside, 9% stop loss. We could even tighten that stop up a little bit if we had to. I wouldn't want to get stopped out too early on this, as it is a nice favorable trade setup, 3.47 to 1 risk reward ratio. And that would be just a retest of 200 exponential. If we get back up to the 200 simple or the 236, the red box area right here, we're looking at something closer to 66% and a 7 to 1 risk reward ratio. So it looks decent, you know, and it's obviously holding up much better than most things are. You know, we're seeing a couple of these like shit coins or random alts actually looking okay. Now, if Bitcoin just goes sideways, the alts could definitely break out a couple of these with nice setups. Most of them look like trash. You know, this one is not putting in new lows. It recently did put in new lows, but it's been strong since then. That's not what we're seeing for most other cryptos. So this one looks different than most cryptos do in a good way. Now, if all of a sudden we see a meltdown, though, this just gets rejected, rolls over, and who cares? Sorry about your luck. But if we go sideways or Bitcoin starts to pump, that could be a quick 30 to 66%. So definitely worth watching. And shout out to the group member who said, hey, could you look at algo? Sure. And then gold is next. XAU consolidating at the 200 exponential. Slightly still above the 200 simple. Wouldn't be unrealistic to think this retest 1837. It's just starting to build up a little bit of support at this level. I mean, this was pretty much our target to downside. So I don't want to get greedy on this. It also kind of is respecting what we had been looking at as a channel based on this like awkward one touch on the heart line. So I think right around this level, it probably does find support and pushes back up here. Does it get all the way back up to 786? Does it get all the way up to 2K and just put in another lower high? Probably. It probably comes back up to about 1960 or something like that. You know, so I would not be surprised to see it push all the way back up here and then again come back down. I do expect it down here at the 382 around like 1816. So 1800 is the key level for gold to hold. We have like this key resistance right here, and that would be just a retest of resistance. So basically be a breakout, a push up, a double top, a retest, support holds. I think it slowly just starts to melt back up. And then eventually if it breaks out of this descending channel that's not quite like formed yet. You know, chops around here, breaks out, comes back up. Then we have our macro cup, our macro handle. And then when we really zoom out, we see this is our macro top from 2011, and that's our cup, and then that's our handle inside of that. So we have like a cup and handle inside the handle of the cup and handle. You know, and targets on gold, if we do break out above that 2000 level, I mean, 2400, 2600, much higher potentially. Or it just goes straight to zero. XAG silver looks absolutely terrible. Looks very weak. Revisiting the lows, technically below the bottom of the channel. Silver is in big trouble right now. It is dangerously close to being a teenager again. It's got that Benjamin Button's disease, okay? It's going backwards. Got to be real careful. You know, 20 bucks. I mean, we're at 22 right now. So 20, another 10% down. After that, 19, 18, 17. Careful. Gold silver ratio chart. So, you know, I mean, I don't want to say I told you so, but above the 200 exponential and simple, they're blue now. Looks like we're headed up here. You know, we're at 85 now. My target has and will be, has always been 90, 92, somewhere around there. We're getting real close to the target. So, and who knows, we might overshoot that massively, and it might go much higher. But right now, we're basically just seeing this play out. I do fully expect. So here's the thing about this. So we had a big leg into it from the high, and then we're seeing basically, you know, this is like a bear flag taking place. This is our leg. This is like our actual flag. And then typically you'll get another leg down. What we have to pay attention to, though, is most of the time, the ascending channel, time-wise, will not be the same length of time as the down leg, or if it was a bull flag, the up leg. So now that this down leg has taken the same amount of time, roughly, you know, not price action, but actual time, days between the high and the low, and now it's around the same as this, the pattern becomes a little less reliable. So we have to be careful that instead of getting something like this, which is what we're expecting basically, the A down, the B back up, and then the C lower, which would be good for silver. Once this stops, it means silver is strengthening compared to gold, means they're probably breaking out to the upside. But while gold is strengthening compared to silver, it means they're probably weak, and silver is just much weaker. So if I'm right about this, and we come back up here and top, I expect silver then, at that point in time, I'm no longer buying gold. I'm not a buyer of gold when this starts to roll over. I'm a buyer of silver. But also, we have gotten back on top of 200 exponential and simple, and typically when we've seen that happen in the past, we went into like multi-year bull markets in the gold-silver ratio. Sometimes that was because gold was going up and it was the beginning of a cycle. Sometimes it was because gold and silver are going down. More often than not, gold is losing value, but silver is losing value faster. Therefore, it's losing value compared to gold. So we're almost there. But this does not look good for silver. And ipso facto does not look good for gold, because we know typically when gold strengthens compared to silver, it's either at the very beginning of a breakout cycle or it's because they're going down. So not good on the weekly if you're a silver fan or a gold fan, but especially if you're a silver compared to gold fan. XPD, palladium, so it finally melted down. So we lost the 200 exponential and simple. Still looks like trash. It's been trying to consolidate around these levels. XPT, you know, just looks absolutely horrendous. Still fully think this goes down, retest the lows. I expect it in the 800s in the next couple weeks to month. ACB, Aurora Cannabis, new low, just absolute trash. Again, we've been talking about some of these potential trade setups and everything. You know, so important to be taking profits on these things, because if you didn't take profits, you just gave back 36% for nothing. 50% on Tilray. I mean, got to lock in these profits and not try to pick bottoms. You know, if you're really trying to build a position at these lows, it's one thing, but you might as well take some profits off the table and then just leave some of the profits in the asset and then just take the capital back so you can't take a loss. I don't like dollar cost averaging into a downtrend. I would rather dollar cost average into an uptrend. You know, which Michael Saylor actually had the right idea, dollar cost averaging up into the bull trend, but what he has failed to do is recognize once the bull trend turned into a bear trend. And that's where everybody loses their money. They lose their money when it goes from bullish to bearish or bearish to bullish because they can't flip. They're so delusional. They're so sure that they're right. They continue to make up excuses. And why does that work or not work? Because they fail to identify invalidation or validation levels. If Michael Saylor was smart, as smart as he thought he would have already had key invalidation levels in play where he said, if price breaks down below this, I was wrong about Bitcoin and I'm going to pull the ripcord and bail on this thing. But he didn't. Instead, he joined and helped fuel the cult of crypto people, which that's fine. That's cool. I mean, a lot of people get rich, but also a lot of people get poor that way too. So, and you know, Michael Saylor is going to be one of them. But I'm sure he'll come up with some other scam in the future or whatever. He'll be like, I was wrong about Bitcoin. It was XRP the whole time. XRP is the best. Oh, MicroStrategy, $1 billion XRP purchase. Well, it'll probably be 500 million after he sells all his Bitcoin at a loss and then buys XRP. So $500 million Bitcoin XRP purchase. Wow, Michael Saylor. ACV terrible. Pot stock's just looking so weak. New low. Again, gotta lock in those profits, ladies and gentlemen. CCJ, uranium, just big meltdown back to 200 exponential and simple. I still fully expect these to go down lower. We've talked about these targets countlessly. URA, same thing. I mean, we're at key support, but I do expect these to go down lower. I think the energy trade is probably going to roll over. I don't know about nat gas, but a lot of the other stuff. UEC, same thing, slightly more bullish. And then UROY, same thing, slightly more bearish. Obviously, still same targets in play. Very, very bullish on uranium long term, but I'd say bearish to neutral short term. Oh, so wait, we did it. We already did the cryptos. We did it. We made it to the end. Yeah. We looked at all the charts and talked about all the things. So yeah, I guess gonna go ahead and wrap it up there. Appreciate everybody showing up today in the chat. What's up, Calma Betty? Good to see you. Thank you, sir. Great analysis as usual. Keep up the good work. Of course, my friend. Definitely. I'll take a look at Hex. Yeah, we could take a look at Hex real quick. Yeah, we could probably look at one Hex. Hang on 1 second. Oh man, I don't really know what exchange is the best to look at Hex. Maybe Uniswap? Not sure what's going to have the best history. Yeah, let's try Uniswap. Look at the old Hex. I'm going to start off by saying this thing is wild. So the monthly chart on Uniswap, we can't really get much from that, honestly. Yeah, Uniswap. Okay, appreciate you, brother. So look at the weekly. Man, I mean, it's so tough to try to chart this thing on a long time frame. I mean, we have a high, then we have a low, then we have a lower high, then we have a lower low. So I would expect this to come up here and put in another lower high. Last time it did it, it crossed 821 back to the upside. The key levels we got to look out for is, you know, obviously the previous all-time high and then the previous swing high. So those are like the key levels we're watching, basically. So, you know, obviously we don't want to see it break below 11.1 cents. You know, if you want to be bullish, you need to see it break above like 29 cents. Until then, it's just an internal retracement of this leg down. So if we look at the previous leg down and we say, okay, from the all-time high to this low, where did it go up to? Well, 618 was the retracement, and then there was wicks up closer to like the 786. And then if we just look for a similar move from this wick right here to our swing low right here, and then we see, well, where are we likely to go? Maybe back to the 618, possibly a wick as high as the 786. But, I mean, to me, I would say this thing looks like it's close to probably topping out. So I think the real level to probably watch for a top on this, again, this is on the weekly chart, is probably somewhere around here. So somewhere around like the 21 to 23 cent range is probably where you're looking for a top. You know, based on just an internal retracement, Fibonacci, lower low, and lower high. And then once we look at it like that, we can then draw, let's say like a parallel channel or something to that effect. If we just go by the closes, we can kind of see how that looks. Not beautiful. We only really have one touch on the bottom. What if we went by the wicks? How does it look? Let's see, that actually looks a lot more realistic. Yeah, so we're probably looking at something like this. A descending channel with a wick top right here, a wick top right here, and then that wick top is potentially, you know, our target to the upside is just the top of the channel again. So we would just continue trading inside the channel. And then after that, probably come back down lower and put in a new low, assuming the downtrend continues. But what I would just, you know, just looking at this, just kind of eyeballing it. We don't know what's going to happen, obviously, but let me just use one of these random tools how you're not supposed to. You know, we're basically looking at something like this happening. So this is what I would expect, you know, to basically continue happening. Something along this line. Just because that's what we're doing. We're just trading inside a descending channel, and we're just about to be back at the top of the channel. So we're a couple percent off the high right now, back above the 8 and 21, which is good on the weekly. And that is a potential 31% upside still from where we're at. But we could have already topped. That might have already been the top. But, you know, I'm pretty picky, so I like to see it hit my targets like exactly. So that's what I would look for, around like 23.3 cents. But I would look to exit that position. And then if it keeps running, if it breaks up from that level and then starts consolidating or whatever, then maybe I'll look at re-entering on a breakout, you know, confirmation of resistance becoming support, and then expect continuation back to, you know, 29 and then maybe 50 again. But in all reality, got to be real careful with this because it basically looks like it's creeping back up to the top. And then after that, you know, the sell-off, assuming we hit our target to the top and then our target back to the downside, talking about another 70% back to the downside. And I mean, this chart doesn't look bad because it went so parabolic, but let's be real. I mean, this thing is wrecked. It's down 68% from the high. Now, it went up a ton. So, I mean, I'm not saying it didn't go up a ton, but it's down 68% from the high now. And that's after a pretty aggressive retrace. It was actually down something like 80% or something like that. Yeah, 82%. So, I mean, anytime something loses 82% of its value and it's still in a downtrend, I mean, I'd be really careful with this. Real careful. If we go to the day, though, the daily's probably looking okay now. So, yeah, it's trying to basically get above the 200 exponential and simple. So, it's caught at those levels right now. So, if we can get back above there and close up here, you know, which is our target, this is going to look like a massive fake out. If I'm right, this is going to be a huge trap because people are going to get bullish again thinking, oh, we're back above 200 exponential and simple. You know, we had a technical breakout because their chart's not going to be drawn correctly, their channel. So, you're going to say, oh, we already broke out, getting ready to go to the moon. And then all of a sudden, that's the top. And then it melts down another 60-something%. And then, you know, again, if I'm right, from the all-time high to our next target to downside, roughly, we're talking about 90% haircut. I mean, that's just brutal. And the way we see this correspondence, so here we see the heart line bounce perfectly, heart line, you know, heart line. You know, we see some pretty clear interactions with the heart line, and then we have 3 touches on the bottom, and we have like 3 pretty clear touches on the top. Now, these are part of the same touch. Arguably, these are too. But if we have at least 2 or 3 touches, it's pretty reliable. So I think this is probably what's going to happen. I would be paying attention to this exact scenario playing out within the penny because we're that good. I mean, it just so happens everything lines up perfectly in this scenario. So I would just be really careful with this one. But again, potential 30% upside, but you got to look at it like this. Look at the risk reward of where we're at right now. Let's just say we trade inside this range. So the best case scenario is The best case scenario from where we're at right now is we move up, assuming we stay inside the range. The best case scenario is we move up 30%. That's good, right? Sure. But the worst case scenario is we retest the bottom of the range, and that's 55%. So this is a 2-to-1 risk reward ratio, opposite of what we want. It's 2 risk for 1 reward. So this is like flipping a coin with your buddy and saying, hey, if you're right, I'll give you $2. If I'm right, you give me $1. So we're trading against the trend with a unfavorable risk reward ratio. So if we have a 60-40 success rate, 60% of the time we're in a bear trend, so it's going to have a bearish move. 40% of the time we're in a bear trend, but it could still have a bullish move. You then have a 40% probability of gaining $1 with a 60% probability of losing $2. So when you really extrapolate that, it's really like 4 over 12. Because now we get $1 40% of the time, so that's 4, and then that's our numerator, and then our denominator is, 60% of the time we're wrong, and if we're wrong, we lose $2 for every one, so we have 4 over 12. And then if you, simplify that down, obviously, just, divide the whole thing by 4, basically, you now have 1 over 3. So you have a 1/3 probability of, 1/3 risk reward ratio, basically, when you take into account probability of success. So you have a 33% chance to make 30%, and you have a 66% chance to lose 60%. So that's not a favorable trade setup at all. It's the opposite. If we're going to take a normal trade setup in a neutral market, we want at least 2-to-1. If we're going to take that same trade setup in a bear market, we want something like 3-to-1. In a bull market, 2-to-1 is great. That's fine. That's awesome. In a neutral market, it's okay. But in a bear market, we want something like 3-to-1 reward for every risk we take. And this is 2-to-1 risk for every reward we get. So this is not a favorable trade setup. The last thing I would want to do right now is take a long on this. If I already had a position on this, I would look at this as a selling opportunity up here at the top of the range. And then if we break out from the range and start to consolidate, and it's like, okay, this is a confirmed breakout. We're seeing strength in the markets. Hex looks good. We're back above 200 exponential and simple. There's slope to the upside. This thing's about to rip. Then you can start paying attention to, a potential bullish trade. Oh, still have it on the short. Then you can start paying attention to, a potential like bullish trade setup from this level for, initially this retrace right here, which isn't going to be much, but then, retesting the all-time highs, and something like this as a stop loss. So now you have a potential for 90% upside with 30% downside, because if you lose 200 exponential and simple again, you assume it's going to roll back over. That gives you a 3-to-1 risk reward setup favorably. And then again, technically we're still in a bear market, but that would be more like neutral if the 200 exponential and simple flip back over. And then you could argue that, it's a 50-50 probability of success, coin toss, but you have a 3-to-1 risk reward ratio. So that's the real trade. Otherwise, realistically, the trade setup to the downside is the best one right now. If you have a 60% chance that we break down from here, probability-wise, and then you have a 2-to-1 reward to risk ratio on a short from here, it's the opposite of what we just talked about. So instead of that 1-to-3 on a long, we have 3-to-1 on a short. And that's after taking in probability and risk reward. So that's what we're looking for. We're looking to trade in the direction of the predominant trend. So as far as Hex, man, well, I mean, that's it. What I just said. And then what do we got? So Kalma Betty, the Shin Chan 2. Are you still long-term bullish on pot stocks? Yeah, long-term I am. Like very long-term. I'm bullish on the actual space, the sector. I mean, who knows? 1, 3, probably 3 to 5 years out. I'm very bullish on them for sure. But short-term, they're the worst sector. I mean, they've literally just been melting down for years while everything else went parabolic. I mean, they had a massive run before that, though. But, I mean, that's the beauty of these markets and why it's so important to pay attention to and trade so many markets, because there's always an opportunity somewhere. I mean, even though I think there's still some legs on the energy trade, we're definitely getting to much more risky levels on it. And I think the next big trades are probably going to be gold miners and pot stocks. I think that's going to be our next big trades. with still in there some of the ones we're already involved with. Obviously, the energy oil trade was big, but like the uranium trade, I think long term that still has some serious legs on it. But a lot of these trade setups are looking pretty tired right now and are overdue for a pullback. And then views on recession. I've talked about the recession countless times, man. With the yield curve inversion and breakout and everything going on right now, and we've already had one print of negative GDP. So, if you say, well, we need 2 quarters with negative GDP print, and that's a technical recession. Okay, so we're 50% there because we already have one. So what happens if this one's positive, the next one's positive, and then the one after that's negative? Well, technically, we're not in a recession, but are we really not? If 2 out of 3 are negative, like, is that not still a recession? The technical definitions are kind of weird, but it's very clear to me with what's going on in the economy, the world economy, with, Europe and China already arguably in recession or very close to recession. USA, arguably, if we told the truth about stuff, either in recession or very close to recession. Not to say that like China's telling the truth about their numbers or anything any more or less than the USA, but I don't trust any of these governments, and we're seeing them say with their official indicators that recession looks likely. So if they're saying it looks like it, it's probably already happening. But yeah, you guys know I have been macro inflation, and then inside of the long-term inflation, my real scope for like the next tradable length of time is deflationary environment. And then inside of that deflationary environment, which I think plays out over the next, like, who knows, 3 to 5 years, something like that, due to innovation and, all the worker shortages and everything like that, I think it's going to fuel, basically a combination of a stagflationary environment. But short term, obviously I'm very bullish on inflation. I never thought it would last this long. We obviously knew there was going to be supply chain disruption, inflation, and we talked about that way back at the beginning of all this. But the real trend is probably still going to be inflationary going into the future. If we're looking at a 20-year period, it's probably going to be deflationary going into the future if we're looking at a 5-year period. And it's probably still going to be inflationary technically by measures for the next, like, I don't know, probably 6 months or something like that. But the truth is, I still feel the exact same way I did before Rona hit. And all through Rona, the whole time I've been saying the same thing. I expect going into the future that necessities are going to cost more money permanently and continue to rise. But accessories or like non-staple goods, more like discretionary type things, are going to lose value going into the future. So I think things like food and energy continue to go up, physical things or necessities for life. I think they continue to get more expensive. But I think speculative assets, investments, etc., are going to be deflationary as we see trillions of dollars in value destroyed over the next few years. But we're in a really weird situation too, because you could be in a bunch of different places on the continent or the world and experience completely different things. But my opinion is honestly that if you need something to live, if it's a necessity, it's probably going to be costing more going into the future. But stuff like big screen TVs and cell phones and tablets and computers and, all this other junk that people bought a ton of recklessly over the last few years, when tight times come, when we start to enter a recession and people need money, they're going to sell off a lot of these like goods and things. People might go from having 3 cars for 2 adults to having 1 car for 2 adults. So now all of a sudden there's 2 extra cars for sale. People might go from having 2 houses to 1 house. People might cut down on their stock profile because the markets are going sideways or down. People might invest less in bonds. Or maybe if rates are going up, people are buying more bonds. Or maybe people are just using savings accounts. Maybe savings accounts start paying a decent rate. Or, some sort of like DeFi staking. I just think that speculative assets and investments going into the future are going to see a big hit in value. A lot of them already have, but I think it's going to be a lot of uncertain times, because the real thing we really have to focus on too, that I think is going to be a big contributor to ongoing inflation permanently. Like when we look out like 50 years into the future, I'm 100% with confidence say things will be more expensive. And the reason I say that is because we went through a massive period of globalization where the whole world worked together in a semi-peaceful way to make things cheaper and more efficiently. And going into the future, that's not going to be the case. We're seeing nationalization start to trend now. We're seeing the beginning, or have seen the beginning, of a de-globalization period taking place. And that globalization has been taking place for 20, 40, 50, 100 years, depending on how you're looking at it and where you're located. So if the world has been working better together to make things cheaper and more efficiently, but it costs them supply chain resiliency, they have basically been sacrificing resiliency for efficiency. So you don't have a bunch of stock on hand. You're buying things from across the country. Or across the world. You're getting things from a bunch of different people. So you're giving up a bunch of resiliency, because if anything goes wrong, you're screwed, because you don't have the stuff that people want to buy from you, or to make what it is that you're making, or whatever. So we sacrifice all this resiliency for efficiency, because we want to make everything cheaper. So we have, we'll work with China, USA, for example. We can't make this iPhone as cheap as a slave can make it in a factory in China. We don't believe in slavery. That's bad. But we also do want to be efficient, because business. So we give up the resiliency of making things at home, and then we get them made cheaper by slaves, and then we just pretend like we don't believe in slaves, or we don't want slaves, or we don't like them. Virtue signal, but we still buy stuff made by slaves. And that's a lot of countries, not just USA. But that's part of like the whole globalization. And even if they're not slaves, maybe they're just little kids working in a factory making $1 a day. It doesn't matter. The point is that we have laws that stop our own people from being allowed to do things. And this is a lot of countries, most of the developed world. You have laws that say, hey, you can't dump toxic waste in, the river. Hey, you can't have little kids work 60 hours a week. You can't have people working for less than livable wages, etc. So we make all these laws that say we can't do that stuff, and then we pay someone else to break the laws for us, but they're not technically breaking the laws, because where they live, they don't have those laws. So that's all part of globalization. So if that goes away, if we can't have, somebody making all of our goods and services all over the world for dirt cheap because of everything else that's happening now, and we want to, get resilient supply chains again, well, the price is going to go up. Because if a slave's making a tennis shoe for $1, and somebody in the United States is going to make a tennis shoe for $6, well, by the time we take into account, now we don't have to ship it across the world, but we have to pay extra money, and then, we have the factories here, so there's extra laws and, regulations, etc. How much extra does that shoe cost? Well, maybe it costs the supplier, I don't know what tennis shoe margins or anything. Let's say they sell them for $100. Let's say it costs them $9 to make the shoe. Well, now if the shoe's price goes up by $5, now it's $14 to make the shoe. So does the shoe go up by $5? Does it go up by $10? Does it go up by $3? I mean, I don't know. It depends, how you look at it, how the margins work, etc. But the fact of the matter is the shoe gets more expensive. So going into the future, I think things are going to cost more money because of deglobalization. But then on top of that, we're going to have things like technology saying, okay, it costs a lot less money to run a McDonald's now because there's a one-time purchase robot that dumps fries in the fryer and, flips over burgers. And now instead of a McDonald's having 6 employees at any given time, now it has 3 employees. So you pay, and let's say an employee at McDonald's makes $30,000 a year. So if by trimming out 3 employees for $30,000 a year, you're saving $90,000, and then you buy 2 robots that cost, $180,000. Well, after 2 years, those 2 robots are paid off, and then all you have to do is maintenance and upkeep, etc. on them. So long term, there's less jobs. So again, technology essentially deflationary. I think right now we're still seeing a lot of the supply chain bottleneck inflation and some of the stimulus inflation from monetary money supply. But I think over the next 3 to 5 year period, we see deflation taking place in a lot of things. But again, we see like the inflation in food and energy and stuff like that, commodities in general. And then I think on a long enough time frame, even with the macro like deflation taking place, that we're going into an inflationary period, like into the future. Now that might change. Maybe we don't have enough, you know, new people being born, or, you know, whatever. I mean, there's like all the birth rate and population growth, and there's a lot of other like deflationary potential aspects in the future. You know, maybe the elites want, you know, less people on Earth, so they end up doing like a China thing where everybody can only have one kid. I mean, I don't know what the future is going to look like. So there's definitely still some arguably deflationary like things into the future. But even if a lot of the deflationary aspects are also inflationary, because if there's less people on Earth to do stuff or create things or work or be productive, then there's less productivity. Then, you know, essentially we're deflationary as people, but then there's also less stuff to buy. So it's all about the relationship between them. So it's a very interesting picture going into the future. But I think when you do like the actual like breakdown and everything, I think in the future, most things that you need or want for your regular life are more expensive. And then I think most things that are perks or benefits or whatever are less expensive, like, you know, real terms. But anyway, you know, that's my view on it. We'll see how things develop, obviously, because I was all about the inflation supply chain issues going into the pandemic and throughout the pandemic. And I was obviously very, very right. But I never in a million years, you know, and we saw the energy bull run, we saw the commodity bull run, we saw the crypto bull. I mean, we nailed all these things, but never in a million years did I think that we would still see this level of inflation and this much complacency from the Federal Reserve. So, you know, in many ways I was right, but I was wrong about just how right I was going to be, because this is far beyond what I ever thought would take place. But at the same time, you know, the whole metaphor for the JP BJ, you know, this is exactly what we were talking about. Everybody's like, oh, they're going to fight inflation. They can't fight inflation. They have to fight inflation. It'll bankrupt everything. They can't fight inflation. They don't care. They've been wanting inflation for so long. The last thing they want to do is be like, all right, no more inflation. We got to cut it off. They have tried and tried and tried for decades to get that 2% target and haven't been able to do it. So now they're making up for lost time, in my opinion. So they're intentionally like slow playing it. They're just sitting back, eyes closed, enjoying the BJ. You know, that's how I look at it. I think JP, the old Powell, getting the BJ. JP on the BJ for as long as he can. But that being said, I think that's as good of a place to wrap it up as any with that little mental thought. Calma Betty says, I think you're right regarding Hex. Thank you, sir. Appreciate your work. For sure, man. For sure. Appreciate everybody tuning in today. Hopefully y'all enjoyed the stream. I'm definitely feeling better. I appreciate all the well wishes from the group members. As obviously I did disclose that I was under the weather. I do appreciate the community, all the good peeps out there. Definitely protect that principle, protect that capital. Be real careful in these markets here. We are seeing a little bit of strength in a couple things, but overall, predominantly, lots of weakness. And no sign that these trends are going to be all of a sudden reversing. I mean, it looks like we're only just getting started. Things that are breaking out to the upside and things that are breaking down look like they're going to see continuation. So we'll see what this week looks like. We know a bad close on Friday for stocks has a very high probability of continuation going into the next week. So that being said, I would expect this week to start off with more selling. Now, do we see a turnaround Tuesday? Do we sell off all week? Do we kind of go sideways? I mean, we don't know. We'll have to play it by ear. But we will be back for our Wednesday stream, 8 p.m. Eastern Standard Time, for the Friday stream at 11 a.m. Eastern Standard Time, and then, of course, next Sunday as well. But going to go ahead and wrap it up there. It is 10 p.m. Eastern Standard Time on May 8th, 2022. Make sure that you remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. And as always, I am Crypto Trend Trader, and I'm out of here. Peace.